I see some green shoots.
We need to have some kind of stupid bar.
I just think this is a classic structure, Lamont.
And I'll show you guys, a little trick here.
When you see some of the stuff that we're working on, you're going to like it.
Welcome back, Wyckoff Nation, to the Wyckoff Market discussion. Today is October 19th, and this is session number 42, episode 321. We have an open door session today, so we have quite a few guests. Welcome to our Wyckoff Market discussion. Let's go through the curriculum really quickly. On Monday and Tuesdays, our flagship course, Wyckoff Trading course, part 1 and part 2. So if you're interested, please look it up on our website. Then also on Monday, Wyckoff Tape Trading Lab together with William. And Wyckoff Bias Game is being released to our practicum students on Tuesday. On Wednesdays, we're here together with Bruce for the Wyckoff Market discussion, and also together with Alessio for the crypto discussion, which is on demand. Fridays, Johnny Scan is releasing his Wyckoff Market report, and Bruce releases his power charting blog and the video on Stock Charts and Stock Charts TV. And over the weekend, you can catch up on our communal Wyckoff watch list, which is done by students, and then also watch the episode of the Anatomy of the Trade together with Franz and John. In the upcoming specials, November 3rd, we will have the start to the crypto special together with Alessio. And as I mentioned this before to our students, the slides are looking already great. The material is just developing. There's going to be a lot of let's look at the trades that we've done in the past. Let's analyze them. There's going to be also a lot of kind of environmental things that we are going to discuss. What are the best selections and trades during the specific environment, and so on and so forth. So go to our website, wyckoffanalytics.com, check out that offer and sign up, and we will be happy to have you there for the November 3rd. Also, for those of you who's going to sign up for WMD, Wyckoff Market Discussion, from today to the next Wednesday, we're going to have a promotion for you. Instead of $99, we're going to have a $79 promotion. So make sure that you register, from today to Wednesday. And then for those of you guys who are our students and you are at a different rate, you will be automatically prorated to this rate. That's what we usually do during those open door sessions. And with that, Bruce, how are you doing today?
Great to be here, and welcome to all our friends and new friends.
Yeah, absolutely. Okay, well, we have a lot to discuss today, so let's just jump right into it. Let's talk about the markets. And this is a very standard chart for us now. We kind of made it a habit to show our subscribers our bias. And when we think about the bias, we're obviously thinking about the trends. And when we think about the trends, we're thinking about the long-term trends, intermediate trends, and short-term trends. And since the March of 2009, that was the secular low, very significant secular low. We're still making higher highs, higher lows. So we're still in the uptrend. And it's a very, very big uptrend. So we can't really make a lot of trading decisions just based on that. So we need to go to a lower time frame. So our intermediate time frame is all about what has happened this year, just because the bear market has started this year. So our call for the bear market came on January 5th. We still have not changed the bias, even though there were attempts, multiple attempts to figure out, if the rally is going to develop. But after each rally, we need to see some kind of confirmation, some kind of change of character in the price structure, and that hasn't come yet. So therefore, our intermediate bias and our intermediate trend is still to the downside. And then short-term bias is still to the downside as well. Short-term bias for us is defined by the swing itself. What is the latest swing? And as you could see, since August 19th into September 13th and then October 7th, we're seeing reversal bars of the attempts to go up, and every attempt is being reversed. Now, for us to call this on the S&P a bias to the upside, we need to see the commitment above this line right here. So above the high of the last significant bar that is attempting to go down. We still have not seen this. So Bruce, here's first thought for this session. I would say that even though the bias is down, I also would describe the short-term bias as kind of being in the trading range. What do you think about that?
Absolutely agree. And we've talked about this in prior sessions, is that we are right at this area of key support, which is the June low. And we had talked about the concept of ice, which is a Wyckoffian concept, and being underneath the ice. And what we want to see to demonstrate that this market has some more important strength in it and doesn't continue to have that downward bias is we want to see it be able to exceed that area that you show as resistance and have a good bullish bar. And so far, Ramon, I don't see it. And
Yeah.
so this is something, now we can have a few weeks of this where we just basically go sideways. But the thing that you have to conclude from ICE from a Wyckoffian perspective is it's an area where there is supposed to be support, and it's been able in this case to slightly breach that June low, and then there's no lift in it. So it just goes sideways. It can't get any kind of a head of steam going upward, and that in and of itself is a sign of concern on a much larger scale. So we're watching this very closely, and we really are looking at this, as you'll see from slides we're going to look at later, is that this market truly is on the edge, and this aspect of the characteristic of ICE is an aspect of that principle.
All right. Well, let's start looking into all of the timeframes in details, and let's start with the big secular trend, Bruce. So what do we see on this chart? What is going on here with the secular trend?
Well, this is classic Wyckoffian trendline construction. And in this case, we call this reverse use of trend lines. And what I do is I put little boxes around where the anchor points for the trend lines are. So we draw on two adjacent peaks here, we're drawing a supply line. That's the line, the overarching line over the top of the market. And we can see that this has set the stride for the secular uptrend in the market. Now, note that we also draw an oversold line, and that oversold line is based on the intervening low, which came in 2011. And so now we have this upward stride, and look at the attempts to go down into an oversold condition at the oversold line, and you can see the very dramatic decline through the low in early 2020 on the COVID low, and then a very sharp reversal up, and then a march up into an overbought condition. Now, the other thing that I put on here is a Keltner channel. This is monthly data. This is the S&P 500, and at the time that it went over the top of those two overbought conditions, which is the Keltner channel and the top of the trend channel, we had said this is overbought, it's a throw over of the channel, and it needs to stay up here. If it doesn't stay up here, the risk is that it's going to come back down into the channel, and then it could move easily from top of the channel to the bottom. It's exactly what we have here. This is what we mean when we talk about being on the edge, because here we are talking about being under the ice. Well, look at where the S&P 500 is on a monthly basis under this channel. And so we have not yet gotten down to the lower Keltner band because it's widening out with the volatility. But as Roman just pointed out here, look at how this happened in 2008 in that bear market. It went right down to the Keltner channel, and you think, oh, that's an oversold condition, and then look what it did afterwards into the 09 first quarter lows. So I'm not saying it has to do that here, but I do think that this is one of the risks and the reason why we're talking about ICE here, because if there's very little demand that can drive prices up from this oversold condition that we looked at on the prior chart, then we have to be concerned about supply engulfing this market again and taking it down to this lower Keltner channel or towards it. And so, Roman, your thoughts?
Well, I'm just gonna kind of like proceed with this to the next chart, Bruce, because we have kind of a similar chart here, but only with NASDAQ. So just want to ask you this question. Is NASDAQ positioned structurally in the same way as the S&P, where we're kind of like on the, on the edge, on the cliffhanger here, and could we possibly go even lower?
Well, absolutely. That is the big concern that we have. Now we're looking at a weekly line chart of the NASDAQ 100. Mega cap names, we're going to look at some of those names later on. But the construction here is traditional Wyckoff construction. Look at the 2010 and the 2011 lows, which are adjacent. Note, and this is a Wyckoff point, is that the stride gets set for a market very early in its uptrend. This is an exceptional example. And this example goes on from 2011 all the way to 2022. It's remarkable secular advance. Now we're oversold here. And there's a red arrow on that at that oversold level, as in the prior ones that we see. Now, what we really want to see happen here is we want to see a rally back into the channel and see if we can't reclimate this market back into the channel and back towards resistance or the overbought line. And if it starts to fade away here, then we have basically a break of the secular advance of prices. And this is a concern.
Bruce, and I see that you have some kind of sentiment indicator here, where we're seeing that we're close to that very, very bearish sentiment. And we'll talk about the breadth today. We'll talk about the sentiment. We'll talk more about, a lower time frame. So, stick around, guys. But Bruce, how do you read the current sentiment reading relative to this secular uptrend lows?
This is an amazing sentiment chart. And note over here in 0809, this box, secular extreme, and the put call, a very high level of puts trading for almost a year in duration, and as it's down in this very oversold level. So the sentiment turned very bearish and stayed that way right into the important 09 lows. Now, you can see that the normal relationship is that it tends to stay between these two boundaries and has all the way through the upward sloping bull market. Look what happens in 2020 to the end of 21. As the NASDAQ 100 is throwing over the top of this channel, this is a secular, I believe, Ramon, a secular bullish bulge, like a climactic bulge over the top of this, right, this big overthrow at the top here. And at the same time, look at all the call buying activity or the bullish activity at the secular extreme. Nowhere in this chart going back to 2008, 2009 have we seen anything like this. This is a very long-term data set. This is 10-week moving average of put call data on the SIBO. And so this extremely bullish condition that occurred in 2021 looks to me like it's some kind of a secular blow-off. And so that's the way I'm looking at it. And note that the S&P 500 in the prior chart did not do this. It could not get up and out of its channel, where the NASDAQ 100, where these mega cap names were absolutely thrown into these extreme overbought conditions, extreme overvaluation conditions.
All right. Well, let's look at now at the same long-term chart, just slightly different perspective. And this is something that we've talked about last week, but I wanted to develop this a little bit more. So this is the chart since 1982 of S&P, and this is a weekly chart. So one of the things that we know about COVID is how volatile that event was, right? So within 30 days, 35% decline, and such a huge velocity, to the downside. When did this happen before? Well, 1987, in the previous secular bull market, which we usually would say that this is the baby boomers bull market from the low of 1974 to the top of 2000. Well, then right now we're in the millennials bull market, right? So, and we could have the same volatile events. Do they look the same? I'd say so. I mean, the price really quickly from the top to the bottom of the channel creates that type of volatility. What happens next? After 1987 drop, we have the price overcoming the resistance. We do the same here in 2020, 2021 into 2022 high, and then obviously after this, we are doing what? We are wanting to retest this 87 low. How do we do this back then? Well, in 1990, we go into the recession and its volatility is still there. It's not the same as 87, but it's definitely there, and it's visible, and it was felt. That recession was quite substantial. And then here today, do we have that test? Not yet. We need to see an increase of volatility where everybody sells everything for cash, and there is some kind of widespread fear that leads to a general capitulation by both strong hands and weak hands just to raise cash. We've been in the environment where the bear market was a low volatility bear market. By the way, where would that be? Well, first of all, let's just finish this thought. If we're going to have that type of volatility, where would it bring us? I think that it should bring us back to this channel. And look how 2009 corresponds really well with the COVID low. Could we have that test into like slightly below 3,000 low, and then start recovering from there, akin to what we've done in 91 into 92, and then maybe just consolidate for some time? Yet to be seen. But definitely when we go to the lower time frames, there are some indications that that could be one of the scenarios. Now, when we look at the previous big bear markets, like for instance 2000, 2003, look at how we're starting the bear market. How would you define the volatility here? Look at the 2007, 2008 period as well. How would you define the volatility there? Volatility relative to what? Well, relative to what comes next. And we're seeing that in both cases, first, the bear market starts with the low volatility, and then that volatility increases. Well, that would be in line if we fall here and increase that volatility and we drop, then that would be still in line with, first of all, this model right here, this analog here, and then with both of the bear markets. So this analog could be working really, really well. Well, the question then becomes is which analog, which market analog? And Kent is saying here, today is the 35th anniversary of the black market, Bruce, which is very appropriate for us to be here on the anniversary.
Remember it well. Pretty brutal. Now, the thing about those two bear markets is that they are distinctly different. They were both very destructive. And so I find this very interesting. Which bear market analog is such a good question.
Yeah,
And
which bear market analog? And I'm thinking like here, Bruce, if we would go to this analog of 87 and 1990, then there is a suggestion that maybe a shorter duration bear market would be better. But, you know, I'm kind of seeing that after this overblown COVID bubble that was created with $8 trillion liquidity, you know, from the Fed, all of the assets are going through the same pattern. And actually, next week, I'm going to bring up the charts that are showing this concept. And that is the concept that all of the assets were moving up, and then one by one, now they're going into the bear market. I mean, like, think about technology stocks, think about commodities, think about anything else that you could think of, cryptos, Bitcoin, oil, gold, now interest rate, energy stocks, and inflation are still going up. So they are behind the curve. So I think that we could create this sequence of those kind of like assets going through the same bubble and going through the same busting period. Okay, well, let's look at these analogs. The first analog is 2008. We've talked about this many, many times, so I'm not going to go through a lot of the details here because we have a lot of material ahead of us. But specifically here, going into the, after the distribution, we're going into the redistributional formation, where we have at point number 5, extension to the downside. This is slightly not updated chart. I apologize for this. So we are right here at this point. And then we go into the rally. And not only the rally, but I would even call this a trading range, another redistribution trading range of you know, smaller duration. And please note how it develops. First of all, you have elements of the demand that are coming in, and you have the pushes up that brings the price in back into the trading range, but not above some of the important bars, not above 1/2 of the trading range. So, and that's very, very important point. In our current trading range, this is this line right here. This is the line in the center for us. Could we produce the rally that would be a change of behavior rally where the price commits above it and then successfully tests that commitment above? Or would we do something that what we've done in 2008, going up the rally, everybody's screaming, it's the rally, we're gonna go up, and then look at the reaction, how deeply it retraces. Next rally, another deep reaction, next rally, another reaction, next rally, another reaction. And then we're starting to top into the lower highs, and then we start going down, and then we break at point number 7, the spring that originated around this area. This is the step-by-step sequence for us as to how we could potentially fail and go into the 2008 scenario, where at point 7, very importantly, we are failing to hold at the support. We break that. We extend to the downside on the increase in supply presence. That increases the volatility tremendously. And then from there, we're failing further down and volatility increases even more. So Bruce, this whole idea of that, yeah, we could be attempting to rally, especially like into the expiration on Friday. We could be where the, you know, the puts to calls ratio right now is 3-to-1. So what would the composite operator want to do? Obviously to take the premium from the put holders, right? So how would they do this? Either the price needs to rally for them and overcome this high and maybe like in the upthrust type of manner, or just to be in the trading range, and that's gonna decrease the premium, and we are very close to that. Or maybe the election, November 8th, and we're still in the trading range, and then that would look somewhat similar to what we potentially could have had in 2008. Bruce?
well, so the only thing I could really think to add here is that this decline from 4 to 5 looks like a bear market leg down in the bottom panel. And then the rally up is really of poor quality. You can see each one of the attempts to surge here is diminished. And so those diminished thrusts ultimately stop, and then you get a couple of tests, and then it fails again and does another leg down. And so this, I think, is very possible. Keep in mind that if these analogs hold, that this period from mid-July to mid-September is a significant period of time. It could very well be that we see the same kind of long period of just trading action taking place into the later part of the year. So I think that is possible. And and that would be maddening to have, for people to have a very dull, quiet market without much movement in either direction. So
let's continue with the analogs, and let's look at the 2000-2003 analog. And the reason why I started looking into this analog, Bruce, is when I look at the technology stocks, and to me, it seems like they are resembling in their movements in this 2000-2003 market, where we had this tech boom and then tech bust. So just looking at the S&P here and comparing S&P from that time, to today.
well,
I'd say
we actually saw an example of that, Ramon, and that was that NASDAQ 100 chart that goes back to 2009, then 2011, that big upward stride with the bulge up and out of the channel in 2021, is that that really was those mega cap. Now they were social media stocks and other things, .com back then. Same concept though, extremely overvalued, had a big blow off, and now we're looking at them, potentially melting down the way that the .coms did back then. So I just add that.
Yeah, but look at how the structural, points are so corresponding with each other. I mean, even looking into this area right here from 1 to 2, what kind of structure do we have here? Stop in action, automatic rally, secondary test, sprint type event that becomes a minor sign of weakness. And we have a lower low here as well. Look at that. And then going into the upthrust here in 2022, and going to the last point of supply here, and then continue to the downside, break into the downside, trying to stop somewhere in the middle, and yet continue with the downward movement until we create some testing, short-term testing trading range, which leads to the best rally at that time for the bear market. By the way, this was a really good call for us. We said that we're going to have not just the rally, but the best rally in the bear market. There is a lot of resemblance going into 4. And then something interesting happened. Let's remember that 9/11 happens here in 2001. There is such an overextension below the support here that we see because of that, terrible event. And then what happened prior to that? Look at this red square, a red rectangle. We have a trading range here. After what? After 1, 2, 3 legs down, 1 or 2, 3, or you could use this as a 3 legs down to the support, and then currently we are in the trading range. And I'm not saying that we cannot rally here. I think that we can rally here, especially into Friday, into the expiration, we can. But the key is going to be, could we overcome this very, very important level? Could we overcome these 2 very, very important bars, which is the Fed catalyst and also the CPI catalyst? Bruce?
Oh, just that red box in the top panel really does have the attributes of being ice, because you can see there's no lift in there at all. It's just going sideways, and then the final decline down to the lows on the right side of that red box produces no lift at all, and then the waterfall decline. And I think that's the reason why we characterize this potentially as being on the edge. We're not predicting this per se. We're just warning that this is a real possibility. And I love your analog, Ramon, because if this is ice down here, the thing that we needed, the thing that happened at 5 at the 9/11 low is that the Fed stepped in an oversold condition. Look at the downtrend channel. That's really a classic oversold with a climax. And that the Fed steps in and started to liquefy the system. And that produced an advance for about 6 months. And it continued to be a bear market thereafter. Now, if we get some kind of an event, and hopefully we don't, but we get some kind of a surprise that gives us a decline to the bottom of this channel in the bottom panel, well, the Fed may very well be forced into some kind of a liquefying action at that 0.5 level at the bottom of that channel. And so I'm not, like I said, I'm not predicting anything. I have no idea. But that is typically what happens when you get a climax low, is that there's something, it could be like some financial institutions in trouble. It could be some external event, who heaven only knows. But here we are just resting on that support level right now.
Mm-hmm. By the way, guys, 3 more points here, and then we're going to move on. If we're going to have some kind of capitulation event, so let's say we consolidate, we cannot overcome this level right here, and then we break and we capitulate, and everybody capitulates and sells all of the assets for cash on all of the time frames, right? So, and we have 5 as a result of this. First of all, this will present a very unique opportunity for a very good swing trade. That's number 1. Secondly, the bear market, if that happens, probably is not done. We still need to sell a lot of the assets after the COVID bubble. And I think we should start calling it. Let's call it a COVID bubble. That's what it is. Like we had the tech bubble, we had the prime bubble, in 2007-8. This is a COVID bubble. So those type of events require such a big capitulation that might take actually more time. I am not very optimistic about the first half or even the first 3 quarters of 2023. I think that we need to, to still kind of like have a lot of that general capitulation. And point number 3, and that is there will come a time when the bullish pattern will look something like this. It's going to be still volatile, but it's going to have very well-defined bullish characteristics, inability of the price to continue with the downtrend, and then characteristically diminishing selling on the last leg into potential phase C, and obviously recovery and confirmation and so on and so forth. So it will be really hard to miss. That's what I'm saying.
Well,
Okay.
And the other thing that comes with that is, and we can look at 2009 as another structural, it's different but similar to this, and that is that at that time people are so beat up that they don't. Not only do they not see the accumulation, they don't want to see it because the pessimism is so deep, and that's the reason we have to, like, say, stay fresh. Be opportunistic in our trading if we choose to do that, but otherwise have a big cash hoard where we can take advantage of these opportunities, say at 5, and then also in the accumulation that takes place after 7.
Okay. Bruce, my next question to you is, well, we're talking about a potential trading range, so that's one possibility. I think that another possibility is actually to have the rally here and to actually continue this rally that we've started off the sprint position. And we'll talk, in the tape reading section of this class, we're going to talk about like what kind of sprint do we have, what do we see there. But we could potentially still go up. I mean, remember that there are levels here that we need to overcome. I mean, like all of this needs to be overcome. The rally could come to this level, fail. It could come to the higher level, fail. And it's still going to be kind of like bearish from that perspective. So on the lower time frame, and now we're going to the daily time frame here, do we have any indication that the rally could potentially continue?
One of the things that we look for is what we call green shoots. And this is really a concept that came to us in our days at Golden Gate University teaching and working with Dr. Hank Pruden. And he very much was a proponent of looking for internal divergence, especially in the structure of breadth. There's a number of ways that we can identify breadth. I'm only showing you a few here, but this chart on the left is the New York Stock Exchange percent of stocks above their 50-day moving average. So we just conceptually in your mind's eye, think about a chart of a stock or an index and being above or below its 50-day moving average as really a measure of its uptrend or downtrend. And we know that the 50-day is much more sensitive than the 200-day. And so it will tend to turn before the 200-day does. So here we're looking at the New York on the left, and there's just 3 examples in this chart. And this really helped us to be able to make the calls that we did earlier in the year for important rallies. And that was, you can see there in January, February, a downside non-confirmation, we call it DNC, and lower lows were made in the index, in this case the S&P, the bottom frame, and then higher low is made in the stocks above their 50-day, which means that internally, even though the index is going lower, individual stocks are starting to catch hold and starting to get above their moving average and starting to move up. And you can see here in the index that after a couple of higher lows in the indicator, that it had a really more important advance in March. And that was an advance that produced a rally of sorts in the market. And then a large decline into May, June. May, so far in my mind, is the internal low for the market. But here you can see that there's an upside, higher low, downside non-confirmation in May, and you get a short-term advance there, but it is a warning of things to come. Then you get a lower low into June in both the indicator, which got all the way down to 10%. Only 10% of stocks on the NYSE are above their 50-day. And you get an oversold condition in the S&P and in this indicator. And then they both start to walk uphill. And I want to make 2 points about this indicator. We look for, or 3 really, we look for oversold. We look for non-confirmation of the decline in the index, and then we look for a turn and we look for directionality, northward directionality. And we got those things in June, where we saw higher lows in the indicator, higher lows in the index, and that was so far the best rally of the year. So we go with the strength internally and also in the index with tape reading skills, which Ramon covers with us. So here the middle chart is the same type of data, but NASDAQ composite. So it's all the NASDAQ stocks. So you can see May to June, higher low, downside non-confirmation, and then lower lows in the index. And this produces a very important advance in June. And so that, and actually note that in this indicator, this is a higher low at the June low in the NASDAQ stocks, lower low in the New York stocks. Interesting. So the NASDAQ was really signaling internal strength ahead of the bigger blue chip names per se. And now you can see again that we're seeing downside non-confirmation September to October, lower lows in the index. And so we have at least the emergence of green shoots. I wouldn't describe that we have good northward directionality yet, Ramon, but that would be the next thing that I would look to see, would be that this indicator starts to really stride upward towards, you know, the 50% level and then towards overbought. And then finally on the right, this is fascinating, Ramon. I didn't show you this chart earlier, but this is the NASDAQ stocks above their 200-day. So think how much slower the 200-day indicator is than the 50-day. And this indicator from June, and I said that the May low was, I felt the internal low of the market. June low was slightly below that, less than 10% of stocks above their 200. Well, look what we're getting here. Now the lowest low on this decline into the end of the quarter in September was 15%, a higher low in the 200. So there is internal uh, healing taking place, if I could use that term, in the internals of the NASDAQ while the index itself is making lower lows. And also on a local basis, you can see late September into October, higher lows attempt to stride upwards in the indicator, and then below you can see the NASDAQ composites making lower lows. So I would want to see the next thing to happen is to see that we start to get ease of movement upward towards higher levels in both price and the indicator.
Mm-hmm.
And I think these are hopeful signs.
Yeah. That was kind of like one of my comments here. So we need to see a confirmation. What is the confirmation? Both the price and the breadth are moving in the same direction, right? So
Exactly.
they kind of like starting to trend up together. So we need to see the price if we're expecting the rally, the confirmation of this rally and the confirmation of the breadth is going to come when this is going to happen simultaneously. Now, the reason why I say this is because the 200 is very interesting picture here, right? So we are making a higher low. We have to think contextually here as well. And Bruce, my question to you is, as the NASDAQ is going down in this bear market, and we're at what, minus 33% or so on the S&P or on NASDAQ, I forgot. Is the moving average moving down with it as well? And then as the tech stocks are, some of them overcoming this 200 moving average because now it's so close to the price, does this produces kind of like this faulty reading for us here? So I'm very curious about that. What are your thoughts on this?
Yeah, so what we're looking for is we're looking for some kind of internal healing, reconstruction taking place at these low levels. And so when we see more and more stocks, which in this case, it's a very small number of the index, starting to get above the 200-day, and it could very well be just because these stocks are so low that they're just resting down here, and a few of them are starting to pop above their 200-day. But this would be the thing we'd have to see that precedes an important advance, is to have some number of leadership stocks turning above their 50-day and their 200-day. This is a breadth characteristic, and just common sense tells us that there are going to be some stocks that are going to lead the way ahead of the indexes, and the indexes are going to mask this internal strength. And this is a big part of, kind of what I call the Where's Waldo exercise, where I'm looking for the stocks that can emerge and lead and find their own green shoots ahead of the indexes, because those are the ones that the composite operator types are starting to campaign. And they will campaign them in an oversold condition where they believe the value zone is.
All right, let's talk about something else, tape reading. Before we do this, a couple of announcements. First of all, for all of our students, Nancy has a message. We apologize, guys, that the link to the session was sent or was not sent correctly and was sent later on. So we just had some technical difficulties, so I apologize for this. Secondly, is this session being recorded? For those of you who are our guests, yes, this is going to be a recording that we're going to post on our Wyckoff Trading Method YouTube channel, so you could catch the whole recording there. And also want to remind everybody who is new that from today we have the promotion going into the next Wednesday class, $79 per month. So consider this offering from us. Okay, let's talk about tape reading, or rather chart reading. How would we read the chart here? All right, so I've identified three big areas. these are the areas of interest to us. This is where we go into deep observations about what is happening in those areas, and could we analog them and extract some kind of deduce some valuable information to us as to the strength or to the weakness of the pattern, or to the continuation or the potential reversal. So in all of these three cases, we see some kind of sprints. I mean, in the second case, it's really hard to say that this is a sprint, more of a stop in action, selling climax. In the first case, we have a sprint plus test relative to the first initial selling climax, stop in action. And then in the current case, we have the stop in action, and then we have the sprint event almost immediately, which is not preferable by any means, by the way. And what do we see? So this is a continuous futures contract. We're seeing that the volume signature on the sprint itself in our current example here is pretty high. What does it tell us? It tells us that supply is still pretty much there. There is some selling that was going on even on this very, very big day. By the way, I've conducted the poll on our social media, and 61% of respondents said that after this day, which was on Thursday of last week, we are gonna go high and overcome this high. So just keep this in mind. That's a sentiment number for us. But if we're thinking about the sprint, in the first example, what do we see the next day is happening? We're seeing a follow through to the upside. Do we see it, let's say, in the second case? Yeah, we have day number one, we have day number two. And then if we're considering this a sprint, which is a true sprint, in this case, look at how we're going up. Then we're having a test, which is at a very, very low level test, and then continuation to the upside, up, up. Then we're backing up, and then we're continuing up, up. So what do we see here after the sprint, after this kind of like heavy sprint? The test is okay, structure-wise, right? So it covers only 50% of the sprint bar. But the volume signature of the test compared, let's say, to the volume signature of the previous tests here, or maybe even the test of this kind, like a much bigger test, 1 and 2, or maybe the test here for this sprint right here. This is a high supply test, again, suggesting that supply is there. So imagine the situation, and this is very counterintuitive. We're saying that the sprint is there, the rally is going to unfold, but because of the heaviness of the supply, we're not expecting the rally to be that great. So it's almost like saying, like, yes, we confirm that the rally will be unfolding. What do we have for the rally right now? Not as much, vibrancy of the rally as you would expect out of the sprint. Remember, by the definition, by Wyckoff definition, the sprint is an attempt or a temporary commitment below the support and then immediate recovery into the trading range and above it into some kind of sign of strength. So we're not seeing this. We're kind of seeing more of the heaviness here. And if we would, let's say, think about the analog here between 2 and 3, a rally up and then a reaction into the testing environment. Here we're reacting to the support. We're not reacting to one half we're not retracing one half, and then we extend into the downside. Accidentally, this is 2008 step number 1, where we are breaking the support and then we are extending the gains to the downside. And then we go into the rally that creates some kind of more meaningful trading range before it goes down. Bruce, what other observations do you see on this chart from the tape reading point of view?
Well, the one point I would make about tape reading is that this is something that Rich D. Wyckoff really was very good at. And when he called it tape reading, he didn't stand there and look over the tape as it was printing. He converted it into vertical charts and then did this bar by bar analysis, which he was so exceptionally good at. And Roman and William do this. and they just do a wonderful job. And yeah, so this tape reading lab, I attend to try to be on every single week because I love it so much. But this is a wonderful way to have an edge in the smaller time frames as you're nuancing your entry points and your trades. So anyway, tip of the hat to William and Roman on this.
Well, Bruce, thank you so much. And for those who are interested, go to our website, sign up each Monday together with William. And, you know, those are very, very lively discussions that we have. And we usually cover the markets and then go into some kind of exercises. All right, Bruce, well, let's come back to the markets and let's talk about the sentiment a little bit. We kind of touched upon this. I said that I was conducting this you know, poll right here after Thursday's bar. 61% said we are going to go up, and not only that, we're going to overcome this high. But what does the CNN Fear and Greed Index tells us, Bruce?
Well, I would point out, because recall that I had said that I think that May was the internal low, and that May number was 7. And then you can see there at the end of the quarter, we really talk a lot about quarter end phenomenon. And you'll notice here, well, first of all, that the high for the bull market came right at the beginning of January of 2022. And the market has changed its character and has been in a downtrend ever since. And so in the case, look at this bulge that we had into the March peak there at the end of the second quarter or first quarter, and went over 50% right there. And then we had the decline into the May low where it went all the way to 7%. That's extremely low reading on this fear and greed. And also on the put calls, they were similar. And then there's a higher low and then a reading down to 12. We were actually able to capture the reading of this dial on the left at when it hit 14 at the very end of the third quarter, the end of September 29th, it went to 12. And so that's an extreme amount of pessimism. And that often coincides with an important low. And I actually think, and this is looking at this indicator now, look at how it's striding up and trying to get into a more overbought level. That shows that there is some bullishness coming back into the market. And I actually think that's a good thing, because you can see as long as this indicator is striding northward, it tends to coincide with rallies in the market. And so anyway, those would be my big thoughts about the fear and greed.
Bruce, the only thing, and I absolutely agree with you, the directionality of the sentiment is important here. I'm just kind of like curious to think about, like for instance, if we're rallying right here of 7, we are definitely producing a really good rally here. Really hard for me to say that this is a really good rally so far. Would you agree?
Yeah. Oh, absolutely. And your tape reading analysis was spot on because of all the supply. And keep in mind, we talk a lot about springs. Well, we characterize these springs as different categories. And this, what we call a number 2 spring, is a spring that comes on very high volume. And so the number 2 spring, as a rule, is always tested. So the CO sees all that volume coming at the lows, and they say, oh, there's a huge amount of supply here. And they go, we need to test this supply down here to see whether or not it breaks loose and goes lower and lower. And what they want to see is the test is a higher low test from the spring low, and the volume is diminished. And that is the always in a number 2 spring, the confirmation of that spring comes on the test and not on the spring itself. So that's a very important concept here. And you can see how Roman was able to demonstrate that in the June lows.
All right, let's go to the puts and call ratio. Bruce, please walk us through this chart.
Yeah, so here the red line, don't pay so much attention to that. That's the daily ratio. And then the white line is a 10-day moving average. And I've been using this ratio for like 30 years, and it's really quite useful. And you can see the COVID low comes with an exceptionally high put activity right there, and then turns. Very unusual event. Well, notice, and this whole period here in 2020 to 2020, late 21, is actually that period that I showed you on the 10-week moving average, the bulge of extreme call activity. And now you can see it's come out of that extreme call activity and now is getting into a more neutral range. But this last turn up is a very high put activity extreme on the 10-day moving average. And it's coming at this important low. And it's more pessimism than we saw back at the June lows, which is where that purple line is that shows the condition there. And so we have a lot of, bottom line, a lot of pessimism here. And the other thing that we look for in this indicator is we look for an extreme of pessimism and then a break of that pessimism by the line turning the other way. And so the line turning down, look at all the prior periods where we get extreme pessimism and then turn the line the other way, coincides typically with a good rally. And so now, as emphasizing Ramon's point from a few minutes ago, is that we're not seeing the lift yet. What we really need to see is we need to see this index starting to really lift and go northward with the decline in the put call ratio. And that would be confirmation that we're starting to get the rally that should occur with this kind of pessimism at this time.
The signals here in the uptrend obviously will be the same, right? So you still need the extremes, but they will be lower extremes. This is the bear market environment, and this is the bear market environment as well. Bruce, I wonder if, let's say, like under the bearish scenario, we consolidate here and then volatility comes back, and maybe we go to like, 3,000 here, right? Do you think that there is a possibility that the put call ratio could actually still go up and maybe even match to or be close to the same high of put calls ratio as during COVID low?
Yes, and it really goes back to the analog we did with the 9/11, and and also the current environment where we're saying oversold is the bottom of that trend channel, which is around 3,200 on the S&P, and that that could be a news-related event. Remember, the COVID low was a news-related event, and the panic of extreme put buying activity coincided with people understanding that we were in a pandemic with a lockdown.
And another question. I'm sorry, Bruce, go ahead, finish.
Oh, and just that we could have that climactic breakdown that takes us maybe down to between 3,300 and 3,000, which I have point figure counts that go down there.
Yeah, and let's do this next week. Let's definitely look at the PNF. Let's look at, I wanna bring that studies on all of the assets going through the same price cycle, and we'll definitely do some other things. So this is just what we do on a weekly basis. So if you're interested, most definitely sign up.
And I would only add, and then I'll shut up, but I would only add that there could be a news-related event that coincides with an extremely high ratio like we had at the COVID low. And it would probably have to be a news event that would bring in all that put buying.
Yes. A question here. So here is the uptrending environment. Could we be, just because the bear market, like if we think about the 2000, 2003 bear market that lasted for 2.5 years, and that actually 3 years, because the top was in March and then the bottom was in 2003 March as well, so 3 years. If we are in that type of environment, if we're in that type of bear market, how would this indicator look like into the end of this whole bear market? I mean, could we have, as we've have had here, a trending environment? Could we have maybe like, some kind of downtrending environment where we're still seeing, those puts being, pretty high? I mean, like the current ratio is 3-to-1. I mean, that's pretty unusual for the put to call ratio.
Such a good question. If everybody in their mind's eye will go back to that NASDAQ secular chart where we have the 10-week moving average of put call, you'll remember in 2010, 2011 that the puts were high and steady high throughout the entire basing process. And so in the last leg of the bear. And so you can see, I believe that's what we'll see here, is we'll see like bear market bracketing, where there'll be persistently high put activity into the end of the bear, just as there was persistently high call activity at the end of the bull. And I don't know when that is. It could be a year from now. It could be 3 months, 6 months, who knows? But I do believe that we'll see persistently high put activity as the market's completing its basing process.
Mm-hmm. All right, let's move on. We're at 4 o'clock. Let's talk now about this, so we're going into the selection. And we're going to look at different things. We're going to look at the commodities. We're going to look at stocks. We're going to look at groups. We're even going to ask your symbols, guys. So get ready if we are going to have that time. But Bruce, let's start with the generals. Let's start with the big caps. So here is a yearly data. We have the price at the top, and then at the bottom we have the relative strength ratio of the stock to the S&P, to the market. So what is the main trend here for all of them, Bruce? What are you seeing here from the price and from the relative?
Well, and these are the mega cap names that dominate the NASDAQ 100. And these were the ones that gave us that big bulge in the secular advance. And what I'm seeing here kind of throughout is it's generally at the lows or lower lows. Meta, lower low. Google, lower low. Tesla about to go to a lower low. NVIDIA, lower low. Mm-hmm. Nice looking base in Netflix. And then Microsoft, lower low. So these are like huge, huge companies, huge market caps. So they are the tail that wags the dog. And the other thing when I was really studying these charts was they're all in some kind of redistribution, Ramon, mm-hmm. and number of them broken down. So May to August redistribution in Microsoft breaking down. Yeah, Amazon, same thing. Meta, same thing. Google, same thing. Tesla, same thing. And so we're looking at a lot of redistribution structures. And in the case of Apple, Apple had a really severe decline August to the present, and it's into the area of prior lows. Whether it can hold there or not, I don't know. But it was had a better rally June to August than these other markets did. So I'd be very careful with Apple, but at the same time, it's a little different look than these other ones are, which are just persistently for sale.
Yeah, and I would be a little bit careful with Netflix as well, even though today, such a great news, the subscribership base is growing. We're seeing, the stop in action of a very severe downtrend, then a sign of strength, then another consolidation, and we are getting out of this. So this is a bullish pattern right here. But still, exactly. If the market is going to go down, you have to keep your hand on the trigger for Netflix if you are in that position, in my opinion. Why? Yes. Because if the market is going to go into the general capitulation, the gravity of that event is going to be so huge that even the stocks that are outperforming, like Netflix or Apple, is holding up better. And by the way, this is a big question of why it's holding up better. Remember that first they sell the laggards, and then on the general capitulation, they sell everything. So that's Apple true. could be sold as well, as we're capitulating, and Netflix as well. Having said this, I think, Bruce, there are some opportunistic trades here that are possible. I mean, like even out of this trading range, out of the spring into the earnings, you could have a very short-term swing trade, and I think you could profit from that.
It's the best looking chart there, in my opinion. Mm-hmm. And then also the other thing we talk about this incessantly here is relative strength. And so you can see that the relative strength for the most part is generally southbound for these stocks. And you really, if that's the picture for relative strength, the institutions are tending to reduce their holdings. So they overown all these. They absolutely have way too much of all of them. They're trying to leak them out of their portfolios as carefully as they can, and they're being thoroughly punished as these stocks go down. And Apple has been one of the ones that has been a breath of fresh air. And but even now, I'm sure they're in some pain after the August decline.
Do you think, another question, Bruce, I mean, like we're saying that, yes, there are some green shoots. The sentiment is too bearish, suggesting that maybe we'll rally from here. We're seeing the presence of the demand on the chart. We've seen the spring. We're saying that, yes, we might have the rally. The rally is not unfolding really well, but just looking at this chart, do you think that there is some kind of short-term opportunity here for them to rally maybe to the resistance of some sorts, like of those redistribution patterns that you've mentioned?
Absolutely, they could rally. These would not be my favorite stocks to trade, but yes, they absolutely could do that. And you make a good point, because remember how we talked about the NASDAQ composite stocks above the 200-day making higher lows, long-term and locally. Well, remember that that's a breadth indicator, so every stock gets one vote. But when you market cap these indexes with Apple that's worth 2 trillion and all these stocks that are worth, $1 trillion and up, these are the big dogs here. But when you look at the NASDAQ comp, it's every stock gets one vote in that breadth indicator. Some stocks are going up, and the question we ask, the Where's Waldo question, is which stocks are going up? And so we look to the groups and the themes where that's taking place. And I would suggest it's in energy, it's in banking, it's in insurance, it's in healthcare, it's in other areas. There are things happening that are constructive, and it's not here, it's there.
Mm-hmm. All right, let's move on. Let's talk about international markets. I mean, we usually don't go there that often, but during the open door sessions, we have a lot of people throughout the whole world. So let's just talk about this. And Bruce, just in very, very quick, simple terms, I mean, to me, anything compared to the US looks like this. I mean, look at all of this.
Yeah.
And you don't have to be a very superb technical analyst to see what's going on here. What is the conventional definition of a downtrend? Lower highs, lower lows. And then when you look at the relative to the S&P, Bruce, also not necessarily like, green shoots here.
Well, the one thing that kind of has me interested in these is look at the local bases and the relative strength in the third quarter. You're starting to see relative strength starting to go sideways or walk uphill against the S&P, and that's interesting to me. And then the other part of that, Roman, is what the dollar's doing, because we can make the case that the dollar has just had some kind of a buying climax and is likely range bound for some foreseeable time in the future. So these are down, but I wonder if the relative strength is telling us to keep a close eye on them, because look at Canada. I see a selling climax in September potentially and a test. Germany, selling climax in September and a potential test. Hong Kong, selling climax, secondary test that goes a little lower. All of these have a similar story, and I think that it might very well be related to the to what's going on in the dollar. And so these are potentially extremely undervalued markets, and could very well produce some opportunities out in the future.
Next week, and we've discussed this before, but well, actually not next week, but let me ask you this question. Do you think that the strong dollar is hurting other economies around the world?
Oh, terribly. And part of it is that the strong dollar many of these countries, emerging countries, and it's really painful to watch because these emerging countries, when they borrow money in the reserve currency. So they borrow in dollars. They don't borrow in their local currency because that's the way they can issue debt. And so as a consequence, when the dollar goes up and up and up in value, it makes it harder and harder and harder for these emerging economies to be able to repay interest and principal on these debt issuances. And so typically when the dollar goes up as fast as it has here, something out in the world breaks. And that could be one of those events that we're looking at that could give us that whoosh down into the oversold condition that we saw for the S&P in the downtrend channel.
Let's talk about China a little bit, because China is, is becoming so much more important this year with everything that's going on in the geopolitics. And this is a very interesting index. I usually look at the FXI, and we saw the FXI, I believe here. No, not here. Okay. Well, Bruce, here we're seeing how the price goes to the support.
Isn't this a fascinating chart?
Yeah. So, I mean, the biggest question is, what's going to happen next? Up or down? What do you think?
This chart, I actually put this together a number of years ago and resurrected every so often. And so I dusted it off just for today. And look at this trend channel, reverse use of trend lines. The supply line over the market is the primary trend line. You can see where we marked it from. Look at the beautiful touches all on the way up, throw over overbought condition at the beginning of 2021, right at the end of the year. And this is monthly data. And then look at the turn down and the cascading down to the oversold condition with some kind of an accelerating climactic surge. And I'm wondering, Ramon, with maybe the inverse of that being the very strong dollar and the climactic surge in the dollar, that maybe this couldn't be an important area of support that we should be watching pretty closely. And now that doesn't mean now's the time, but it could build a cause in here for some period of time, as it did in 08, 09. And
yeah, we need something similar. I mean, unless we're expecting some kind of V bottom, but with the V bottom, you need acceleration to the downside. And here, there's not that much of the acceleration. This is more similar to 2008 and then to 2009 low. So I'd be thinking like if we stop here, if we truly stop here, then we need to have some kind of course, as Bruce has said. If we don't stop here, we produce a break, this would qualify as a sign of weakness. And then again, Bruce, I mean, this whole story between the US and other countries, look at the relative strength here. So what could you say about that? And wouldn't you be kind of concerned about the break of the support of this relative strength?
Absolutely, and I would be looking for some kind of a basing structure in the relative strength as we saw in 2016 or we saw in 2005, 2006, and we're just not seeing that yet. Now, that doesn't mean it couldn't come later, but we do have a very oversold condition. I love rate of change. 12-month rate of change is now oversold as it was at 2008. So pretty oversold. Not a reason to buy. But
By the way, I think John or someone else was asking, Steve was asking, how do I get this discounted rate? So go to our website, wyckoffanalytics.com, find the Wyckoff market discussion under the live education here, third option off the top, and then scroll down, and here's your rate right here, $79 and not $99. You could also buy the quarterly subscription as well, and you could buy those in cryptos, USDC. So, definitely take the advantage of this offering. Okay, Bruce, let's.
Let me just say that there's no limitation or restrictions or anything. Give us a try. I mean, it's like we are a very robust community of Wyckoffians. And we have a great group of people in these sessions, and come join us, check it out, because I think that we get a lot of good feedback in the terms of good chart studies from our community. We talk about your ideas, and we would just love to have more Wyckoffians in our community, or emerging Wyckoffians, new Wyckoffians.
Mm-hmm.
So give us a try.
Speaking of the community, Johnny Scan releases his Wyckoff Market Report each Friday. Check it out on our website. This is just kind of like, a couple of pages from this report. The uniqueness of this report is that John creates the scans around the Wyckoff events in the trading range or in the trending environment. And contextually, depending on what the market is doing right now, we look at those scans together in these classes as well every other week, and we're trying to identify whether that scan is appropriate for this environment or not. So just check it out. Go to our website. There are a couple of free issues from the past that you could check out as well. Bruce, let's go to the next subject for us. We keep talking about US dollar. We keep talking about the interest rates. We definitely spent so much time in the previous, 2-3 sessions leading to the Fed minutes, most recently released, and also the Fed rate hike about the inflation just in general. And we have, such a strong position about, what the Fed is doing, how the inflation might be unfolding, what we should be expecting in 2023. But let's talk about the dollar and the bonds here, TLT. So I guess my question here on the dollar chart, which is the UUP, this is the ETF for the dollar. As we are having this climactic surge, and the PNF has identified for us that this is the area of where potentially we're going to have that stop in action. And that stop in action is coinciding with the long-term uptrend lines. And what should we be expecting here? Should we be expecting here some kind of change of behavior, a trading range, or as we did with, let's say, COVID or back in 2015, should we have some kind of more meaningful reaction to the downside? What are your expectations? And how does that gonna influence the market?
Yeah, so I think we're going to get something a little different this time, but we have been keeping track of this trend channel for a very long time, literally since the first quarter of 2018, when those two adjacent lows came in and we drew this upward striding channel. And look how beautifully it worked in the first quarter of 2020 at the COVID, and then just reversed really sharply off of that to the oversold condition in 21. I suspect that the reason that the dollar went down as sharply as it did was because of this, just the sheer amount of liquidity and that was pumped into the system by the Fed, and that had the effect of driving the dollar downward. Where now we have the opposite condition, which is the Fed is actually reducing their balance sheet, tight money timing, I call it, and we have a throw over of the top of this channel again on an amazing climactic surge that's occurred up into this 30 area. And then Ramon, if I had meant to send the chart up to date, but everybody can update this and see, do a daily or a weekly, but look at the reaction off of this overbought condition, and you can see it came right down to this 29.5 level. And I believe that this is a buying climax, automatic reaction that we're in, and you can draw resistance and support, and that we're in a range bound condition, and that and I would draw just above 29.5 there, yeah. And then it may go a little lower. It could maybe even go down to 28, because that last move up was so dramatically accelerating. But I think that we're going to spend time now range bound, possibly building a cause for another move up. Too early to tell, but I do think the dollar is changing its character as the third quarter ends and the fourth quarter begins. And so I believe that that will have a profound effect on a number of different international markets. I think it'll have effects on stocks and so on. And so I'm very, very curious about the dollar. We're going to check it regularly and keep a very close eye on it. And I do think the condition will be different than it was back in 2020. And then if I could just say briefly on this chart on the right, this is the 20-year Treasury bond. And this, the dollar going range bound may very well change the tenor of trading in the Treasury bonds. But there's our distributional top, the light green shaded area that occurred back in 2021 with just a big breakdown, sign of weakness, attempt to rally, which is a rally into the ice up to 142. And then, yeah, see that? And then a wedge, look at that hinge there, and then an absolute breakdown. And so I tend to be conservative in my distribution counts 101 to 91. And then I had originally put this redistribution count as 7 columns. I just widened it out and to 9. I think this is a good count for a redistribution out to this 9 columns, and it gives us a countdown to 93. So I think it's possible, and it also confirms the count of the distribution area. Stepping stone, redistribution, confirming count.
All right. Okay, Bruce, we are at 4:22, and we have quite a lot of still slides ahead of us, but I would suggest that maybe we're gonna preview the slides of what we're gonna show you, and then instead, Bruce, go for the people's symbols. And for the next, 10 minutes or so, we would just do the selection based on the people's symbols. And then next time we could go through crude, natural gas. We wanted to look at the gold, silver, all of the metals. That was one of the requests. Currencies, Bitcoin. And then, by the way, speaking of Bitcoin, I want to mention that, again, what a great crypto special we are expecting starting on November 3rd together with Alessio. So definitely check that out, especially if you're a crypto trader. Bruce, what do you think? Should we go, through people's?
Yeah, let's just show them what we're going to do. We'll do these next week, but let's do symbols. Let's do symbols.
Okay, let's do symbols. Okay.
Because it's so much fun.
Yes. All right. So here is the first stock. This is the software Snowflake. What are you seeing here, Bruce?
Well, I see a possible accumulation, cyclic accumulation type structure with what appears to be a May selling climax type event. Look at the huge amount of volume in late May, and then range bound. Then it starts making a series of higher lows. So it comes out, now it's backed up to where it broke out in early or late July. But what I really love here is the relative strength, because I love to look for relative strength structures, and that looks to me like an accumulation style structure, and now it's above the moving average. And I'll tell you what, it's like these institutional money managers are out in the desert with no water, and their water is relative strength. And a stock like this, I think, would be very attractive to them. So this is a very interesting idea.
Mm-hmm. I'm a little bit concerned about the emergence of the supply right here that's still kind of like persistent in this later part. So I wonder if before we go up, we might have like, some kind of leg down. Okay, let's go to the next one, DXLG. Okay, so this is then apparel retailer. Definitely from the look of it, you want to like a lot of things about this, so I'm going to go really quickly. Prior uptrend, consolidation as a causality. Within this consolidation, you have a spring event. Out of the spring, and this is how the spring should behave, we're seeing the continuation to the upside, and then a very, very shallow flat backup that is a trading range on its own. Behind it, some buying and the relative strength. So this is those green shoots that Bruce talked about, and that we definitely want you to explore and to be in this type of the environment where the uptrend is still not confirmed. So you want to go to the candidates on the long side that are outperforming right now, that have a complete reaccumulation or accumulation structure. Those are the safer candidates for us. Okay, let's go to the next one. Bruce, your favorite?
So Schlumberger Oil Equipment and Services, and this is a stock that I've been trading throughout the uptrend, and just really love it. And the thing about oil service or oil equipment is it has been somewhat of a laggard for a long, long time. And now all of a sudden it's catching a head of steam and starting to lead. And I think that's because there is just more oil drilling and pumping going on in the world. Huge beneficiary of that condition is Schlumberger. And so you can see here, look at this sharp pullback in September, and all it does is pull back to the rising moving average on the relative strength. Relative strength looks like it's making the base back to June. And so you can sometimes see the base better in the relative strength than you can in the price. And so I just think that late September low is an LPS. And now it's showing a huge change of character and moving up quite easily back to the June highs. So I like it.
All right, let's go to the next one. This is a biotechnology stock. And out of the base information, which I would define the trading range as such, we're seeing what? We're seeing higher highs and we're seeing higher lows. We're seeing that the relative strength is in the same pattern of an uptrend. And again, these are the candidates that we want to pay attention to. In this type of the environment, these are the candidates that we want to be in. Now, I think that the timing here is kind of like the most important thing. So thinking here that we might be in some kind of trading range, I would just continue monitoring this until we reach a logical point, a logical conclusion, let's say in Wyckoff methodology, that would be phase C. So where is phase C? Is it coming soon or should we wait? So that would be the only concern for me here. Okay,
Yeah.
Bruce.
Interesting, but it is a very tiny company, 500 million market cap. So
Bruce, a question for you, and can you continuous update on the Bristol Myers, please?
So a really good rally December to April, and now we have what, let's say that's a reaccumulation. The thing that I'm concerned about, a lot of volume into that breakdown in late August, and the rally has just basically gone up into overhead resistance, old support where it broke down. This is a really tricky place because I think it needs in very short order to get back up into the trading range. And it would become, I think, a much more attractive stock if it could do that. And it's right there knocking on the door. So right now, I just the volume is kind of low on this little pullback day that we had. I guess that's today. And so maybe if it can just stall in here and have the volume dry up, I would consider this to be interesting. So that would be my only concern, is that it's up against overhead resistance. Needs to prove itself.
All right, let's go to the next one. Next one, life insurance. Bruce, you mentioned insurance stocks. So what do you say here?
Yeah, so insurance stocks, bank stocks have been sort of a breath of fresh air. So a very sharp break down into late September into the end of the quarter. And that could very well be like a phase C event, like an LPS going back, and this could be reaccumulation back to the early March low. So look at that climax, selling climax in March, automatic rally, support, resistance. And then I like the way that it rallied suddenly sharply off that late September low and had a really good up bar. And then look at the pullback to 46. very tight ranges on that pullback. A little bit of volume came in the last 2 down days, and then another really good demand bar, and it's just moved right up to the 52 highs. So I like the way this is trading.
Okay, let's go to the next one. I'm sorry, I got one more I. Okay, telecom equipment.
You
Yeah,
know, I
and
have to say, Ramon,
yeah,
before you start, it's
sure.
so much fun to do these because we have such a great community and all of us are putting eyeballs on the market, and you have just a lot of really interesting ideas. And for us to be able to look at those ideas together is just a value to all of us. So this is why this is one of my favorite things to do. I'll
Yeah.
leave it at
I would say this is a really interesting swing candidate. Why? Because of the strength, right? So what are we doing throughout the whole 2022? We're going down. But yet in May, June, we're seeing strength emerging. We're seeing the volume signature expanding. And behind this expansion of the volume signature, we're definitely seeing the expansion of buying. And then look at how flat the current range is. And even though some volatility comes in, on the increased supply signature, we are seeing a higher low and then immediate quick recovery. So it's almost like it's attempting to go down, and yet it cannot do so. So this would be on my short list for the swing candidates, especially if the market is going to start rallying from here, even if it's a laborious rally. Stocks like this are going to be very, very favorable for us to trade to the upside on a short-term basis.
Let me ask you one quick question, Ramon, about
Mhm.
you are somebody who currently works with institutions. Me, I used to be an institution. It was a long time ago, so I'm retired. And so, but looking at this rising relative strength with this structure, do you think that this rising relative strength is attractive to institutions?
Well, absolutely. I mean, like institutions basically use two things, price and relative strength. I mean, like everything else is kind of like secondary data that they use. And when you see such a strong buying, and relative strength is what? Relative strength is basically outperformance relative to the market proxy. And what do institutions need? They need absolute and relative return. If they don't have relative outperformance in their portfolio, then most likely they're going to start trimming that type of position away from their portfolio or closing it altogether. This is not one of them. I mean, we're definitely seeing an increase in market participation from market participants, and also the strength is being reflected by the distance between the moving average and the relative strength itself.
Thank you.
Okay, Bruce, we are at 4:33. Let's do a couple of more and then we'll stop here. Bruce, this is from the energy sector.
Professional bull riding. So this is a very important Brazilian oil company, somewhat owned. It's owned by the Brazilian government and by individual investors, kind of a hybrid, large company. And you can see that now you can see the yield here, 42%. I was looking at the yield characteristics on this, and I believe it might have been a one-time distribution. So this is not the yield, and I don't believe. And
Okay.
but
Yeah,
you
that
can
looks
see,
very strange.
yeah. So anyway, pulls back to 12, 12 and a half, which is the prior May peak, and that's a form of support, and then turns right off of that, goes up. Look at the area of the prior highs in August. Look at how it gets real dull and quiet and goes into a tight little trading range, which we would call a backing up action. And now it's turning up and it's trying to take out the August resistance at this level. And the volume is percolating upward. Relative strength is really good. And so, it's a very attractive trading idea here, very interesting trading idea. Just keep in mind that they have there might be political characteristics as a stock that was a high flyer many years ago and has became a low flyer. So, but right now, from a trading perspective, locally, it looks very interesting.
All right, two more and then we're done. Tesla. So I would say that Tesla still needs to show us more green shoots, in terms of how it could stop in the area of the support, maybe consolidate a little bit, and then have the rally to the resistance. That would be the most favorable bullish scenario without the continuation to the downside. Otherwise, if we would look at this pattern, then we're still in what, guys? In a downtrend. And this is where we are. So again, we just have to wait and kind of like see, is there going to be a continuation or there's going to be some kind of reversal. Now, by the way, this area right here, and I had such a great trade right here, swing trade, took this whole thing down. But this area right here, go to Apple, and this is a homework for next week. Compare this area in Tesla to the Apple, to the current Apple chart, and email us your thoughts on this. Okay, Bruce, last one for you. Starbucks.
Oh yeah, that's an interesting chart. Made a beautiful swing trading structure back April to July, and really signaled that it wanted to be a swing trading candidate. That July pullback, shallow, brief, to a higher low, and then out it comes. So now looking at this, it looks like it's in a range bound condition. I would say the default is for higher prices, good relative strength. I think that there's the possibility that it could be bought down towards the support line for those that want to swing trade it again. And it's building a cause. So it built a cause in the base, July to April, and now it's building a cause again for potentially another reaccumulation for another move up. And so I just think that there could be a little more time in here before it starts to go again.
All right. All right, guys. Well, that's it for today. Thank you so much for being here, and we're really happy to have all of you here. We definitely want to see you for the next week, so don't forget to register at the promo rate. Bruce, that was a good session. Thank you so much, and I'll see you guys and you, Bruce, next week.
Thank you all. Have a great week.